Welcome to the chart. What if I told you that you have been placing your stop loss the wrong way as far back as you have been trading? Here we are going to be showing us how to place our stop loss just the way professionals do. And what if I told you that you have been placing your take profit the wrong way all this while? Here we are going to show you how to place your take profits just the way professionals do. Stop losses and take profits are very overlooked areas in trading analysis, and these two factors, they are the ones that get traders the most, because an attachment to a trade is defined by how flexible a trader is in his or her analysis and how you hold dearly your area of entry as well as your areas of exit, because entries and exits are of high importance in the market. Where you enter is as important as where you are going to exit from. For instance, we are going to take a look into different setups. We are going to look at a setup where price misses the take profit slightly and goes back to the stop loss. There is nothing special about a stop loss. It is just a stop loss. It is just a losing trade. So you have to have a POI, a point of invalidation. Just as you have a point of interest, which is the take profit where you expect price to reach, you also have to have a point of invalidation where if price goes back and reaches that zone, then you know that the market is absolutely against you and there is no need for further resistance, as further resistance is of no use in forex trading. So the two most important things are your areas of entry and your areas of exit. Once you have your area of exit in mind, just like your area of entry, once you have it preconceived, then if price gets to your stop loss, fine. If price gets to your take profit, fine, because you have already predefined those two areas before taking a trade. However, if the case may be that you only have your area of entry preconceived while your area of exit you are emotional about it, if price goes against you, then you keep on moving your stop loss till your account gets liquidated, and the market doesn't care. The market reduces all traders down to numbers, and on the chart we are all nothing but numbers. So the market works with only numbers. It doesn't care whichever money you use to fund your account. It doesn't care whichever money you use to buy a challenge. It doesn't. All it does is go up or go down. So now here we are going to show us how the professionals in the game beat this psychological human weakness, because once you are robotic in your trading or once you are mechanical in your trading, definitely the market will pay you, because the market is also mechanical. The market does not run on emotion. It is only the market participants that are emotional, but the algorithm of the price where chart moves to, it doesn't care. It only moves to where one big money is, to another zone where another big money is. So now let us look at this sell pattern on AUD JPY. Here we have a liquidity zone taken out and we have a classic engulfing sell pattern here. We have an engulfing sell pattern here, and we can see the pattern in this red box. Let us see the pattern in this red box. You can see the BS creating fear. The BS creating fear. The buyers being optimistic and you can see the BS creating fear and panic, manipulating more buyers and pushing price down and price retest. So let us say that you are entering on a 20 pip stop loss. This will be your entry right here, this blue line. So where do we set our stop loss? We set our stop loss above the above the bearish engulfing candle, slightly above or above. This will be our point of invalidation. So our entry is this blue line, this is our stop loss. So if price comes back and spikes this zone, then we know that this setup is invalidated. Then we give up, we move on to the next trade, we forget about whatever has happened here. Whatever has happened here is just going to stay in the trade journal. It is not meant to stay in our head. And this will be our entry. So we set our stop loss at our entry and stop loss at 20 pips, then we target 100 pips. You can see this is the 100 pips, but once price goes down, price misses it with some few pips and goes back up to stop us out. This is a perfect way to set your stop loss. So you don't mind people that say that you give your stop loss more room to breathe, whatever. Once you know that this is the highest point from where the sellers push price down, so this is the point of invalidation. If this zone, just like a ceiling, if it doesn't hold the pressure from buyers to push price further down, then we know that the sellers here have given up. They are not ready to sell further down and the buyers have taken over. So there is no need for further resistance. It is that simple. But let us say that we don't have our stop loss here and we are being emotional. Once price goes against us, all we do is pray, wish, hope. And praying, wishing and hoping are not trading strategies. They do not work in the market. So that is why it is good to have a fixed area for a point of invalidation and be ready for whatever the market does. So you can see the market comes here, it does not reach our preconceived area and it goes back and stop us out. So this is the perfect way to set your stop loss. That's why it is a stop loss, to stop further losses. So let us say that you don't have your stop loss here and price comes here and spikes down. The only thing this will do is to breed more indiscipline in you, because you feel you are smarter than the market, and the day the market would go totally against you and blow your account is coming. So it is good to have a disciplined mindset, to have a preconceived area of interest and a preconceived area of exit. So let us say you only have your entry and your TP in place and price rallies down, then price goes back up, misses this bearish engulfing candle and price comes down, you'll be happy. Meanwhile, you are making money on this trade, but you are destroying your trading discipline. That is why we must always have a fixed stop loss, just like this. This is our entry, this is our stop loss, this is our take profit. That's simple. And setting your take profit, you shouldn't go for anything less than 1 to 5. Let us go and look at another setup and see how we should have leveraged and see how we should have performed. I'm coming. Okay, now right here, let us say that this is a bullish engulfing right here, and let me clean these blue lines. Let's just say that this is a bullish engulfing and we have our stop loss here 0.61895 and we want to enter on a, let's say, a 10 pip stop loss, then we set it at 0.61, it should be 0.61995. 0.61995. Yeah, 0.61995, and we are targeting a 1 to 10 RR, and we set our TP to 0.62995. 0.62995. So now we can see on this trade, these are stop loss, these are entry, and these are take profit. So all you have to do, once you set all this, all you do is relax and allow the market to do its thing. So you can see that market eats the take profit, you take your profit and you leave. And you know that if reverse was the case, if price spike this zone to drop down, you know that your setup is invalidated. So that is how professionals, that is how they, because the reason why we put our stop loss here are this bullish engulfing, sellers create fear and panic, the bulls take over. You can see confident buyers, optimism, confidence in the economy, and the buyers are buying more till price reaches take profits. Then we know that this level, if price breaks it down, we know that this is the level where the strongest buyers are no longer ready to buy this position. So this is the level right here. So whatever setup you take, it should have technical basis, maybe based on candlesticks, based on, although I'm a specialist in candlesticks, so I prefer candlesticks. So you already have in mind where to place your stop loss. You know the strongest level in that particular setup, so that's where you place the stop loss. So you can see in this bearish engulfing, this is where we have the strongest buyers below the bullish engulfing. So we put our stop loss directly below the candle, and if it is a bearish engulfing, it will be on top. Let us take further examples to learn more. Here we can see a bearish engulfing. You can see this setup. So now place our stop loss above. This is our entry. Then we go for like this 15 pips, and we go for a 1 to 8, and this is the take profit. So where you place the stop loss is the most important. Above an engulfing candle, or maybe above a doji, or whatever candlestick pattern entry you base your methodology on, you place it slightly above. Not that you be giving market room to breathe or room to play with your money, because once price breaks this resistance, that is where you have the strongest sellers. So whatever happens after price breaks here is luck. You cannot determine it technically, because this is the only technical basis for this sell. This is the only technical foundation. So the strongest point of this resistance, that's where you put your stop loss. That is how professionals do, and you need to imitate and emulate them to get the results they get from the market. Let us take another example on USD card. Here we have a bullish engulfing. You can see sellers trying to create panic, then the buyers take over, and we set our stop loss below the engulfing candle. We enter directly on 20 pips, and we target 1 to 5. This is the take profit. And you can see as price engulfs, retests this zone and drives up to the take profit. It is that simple. So this is the strongest point for the support. This is where we have the strongest support from buyers. So let's just say that price comes down and breaks this zone, then the setup is invalidated. This is the point of invalidation. Then you know that the buyers are not ready to hold this trend anymore. So the point where the buyers will be unwilling, that is where you set the stop loss for a buy position, and the point where the sellers will be unwilling, that is where you set the stop loss for a sell position. Here you can see this is like a railroad track pattern, and you can see these are the sellers dominating here. So this is the point where the sellers will be absolutely unwilling to put the stop loss there. This is your entry, this is your take profit. So for your take profit, your RR, you go for nothing less than 1 to 5. I advise nothing less than 1 to 5. So on your own, look at the chart, modify your entry, modify your exit, and place your stop loss just the way professionals do.